Hi, hello, greetings to everyone, and welcome to our video lecture series in Introduction to Agriculture Policy and Development in the Philippines. So, in this video lecture, we're going to discuss the part 1 in Unit 5, Agricultural Financing and Support in the Philippines. Okay, so welcome to our agribusiness community. So, my question is, are you passionate about agriculture and its endless possibilities? So join us on our journey to explore the vibrant world of agribusiness. Like, follow, and share our channels to stay updated with the latest insights, tips, and trends in agribusiness. Let's grow together and cultivate a thriving community. Your support means the world to us. Together, let's sow the seed of knowledge, innovation, and sustainability. Agribusiness, see you in our next videos. Okay, so for our introduction, so in agricultural financing and support in the Philippines, in this concise presentation, we'll unravel the critical elements of agricultural development policies and financial mechanisms that underpin the farming sector in our country. Agriculture stands as the cornerstone of our nation's economy, serving as a primary source of livelihood, food security, and rural development. And today, we'll explore the significance of agricultural financing and support system in propelling our sustainable growth and empowering our farmers. So I invite you to join me as we navigate through the dynamic landscape of agricultural policy and development, uncovering opportunities, challenges, and innovative solutions that shape the future of Philippine agriculture. Together, let's embark on this enlightening journey together. Thank you for joining us. So first, let's take a look about the definition and scope of agricultural financing. The first is the credit provision. Agricultural financing involves the extension of credit or loans to our farmers, agricultural cooperatives, and agribusiness enterprises for various purposes, such as purchasing inputs, for example, our seeds, fertilizers, pesticides, and acquiring machinery and equipment, investing in infrastructure, and meeting working capital needs. Then, our risk management. Agricultural financing also includes mechanisms to manage risk associated with agricultural production, such as weather related risk, price fluctuations, and market uncertainties. So, this may involve the provision of insurance, products, risk sharing arrangements, and innovative financial instruments to mitigate losses and stabilize income for our farmers. Then, our investment in agriculture or agricultural infrastructure. Financing agricultural infrastructure projects such as irrigation systems, our rural roads, storage facilities, and processing plants is an integral part of agricultural financing. So these investments enhance productivity, reduce post-harvest losses, and improve market access for agricultural products. Then our capacity building and technical assistance. Agricultural financing may also include support for capacity building, training programs, and technical assistance aimed at improving farmers' financial literacy, management skills, and adoption of modern agricultural practices. So, this enables farmers to make informed financial decisions, enhance productivity, and adapt to changing market dynamics. Then, our value chain development. Financing initiatives often target specific segments of agricultural value chains, including production, processing, distribution, and marketing. By providing financial support to key actors along the value chain, agricultural financing promotes efficiency, competitiveness, and value addition and thereby creating opportunities for increased income and employment in rural areas. And also for promotion of inclusive finance. Agricultural financing aims to promote financial inclusion by ensuring that smallholder farmers, women, youth, and marginalized groups. So these marginalized groups have access to affordable and appropriate financial services. So this involves developing um, what we call this innovative financial products, expanding outreach to underserved areas, and leveraging technology to enhance acceptability and convenience of financial service. Okay, next is the policy and institutional support. Agricultural financing initiatives often require a supportive policy frameworks, regulatory mechanisms, and institutional arrangement to foster an enabling environment for investment, innovation, and sustainability. Governments, development agencies, financial institutions, and other stakeholders play crucial role in shaping agricultural finance policies, promoting public and private partnerships, and strengthening the institutional capacity to support the agricultural sector. So, in summary, agricultural financing encompasses a broad spectrum of financial activities and interventions aimed at facilitating investment, enhancing productivity, mitigating risk, and promoting inclusive and sustainable development within the agricultural sector. So it is a critical enabler of agricultural growth, food security, poverty reduction, and rural transformation in economies around the world. Then next, let's discuss the agricultural financing, understanding the basics. So the importance of access to finance for our farmers and agricultural enterprise. Access to finance is critically important for our farmers and agricultural enterprises for several reasons. Number one is the investment in inputs. Farmers need access to finance to invest in seeds, for their fertilizers, pesticides, machinery, and other inputs necessary for agricultural production. Without access to credit, farmers may not be able to afford these essential resources, leading to a lower yields and reduced productivity. Then, technology adoption. Access to finance will enable our farmers to adopt new technologies and practice or practices that can improve efficiency and productivity on the farm. So this includes investing in modern irrigation, precision agriculture, technologies, and improved crop varieties. So these technologies can help farmers increase yields and also reduce input costs and mitigate the risk associated with weather and pests. Next is the expansion and diversification. Finance allows farmers to expand their operations and diversify their income stream. So the income stream will provide the capital needed to purchase additional land, invest in new crops or livestock, or explore alternative agricultural enterprises. So diversification can help farmers spread risk and adapt to changing market conditions. Next is our seasonal cash flow. So in seasonal cash flow, agriculture is, well, it is a seasonal business. We, um, our income often coming in only once or twice a year at harvest time. So access to finance provides our farmers with the working capital. They need this working capital to cover the expenses throughout the year, including the labor costs, the equipment, the maintenance, and other operational expenses. Then our risk management. Agriculture is inherently risky. with factors such as weather, pests, and market fluctuations impacting farm incomes. Access to finance allows farmers to manage this risk by purchasing crop insurance, hedging against price volatility, and investing in risk mitigation strategies such as the diversification or irrigation systems. Then our value addition and marketing. Finance can support value addition and these value addition activities such as processing and packaging. So which can help farmers capture a more of the value chain and increase the profitability. Additionally, access to finance can enable our farmers to invest in marketing and distribution channels, allowing them to reach new market and command a higher prices for their products. Long-term sustainability. Finance can also support investments in sustainable agricultural practices, such as organic farming, conservation, tillage, and agroforestry. So these practices not only benefit the environment but can also improve soil health, water conservation, and long-term productivity. And through this, ensuring the sustainability of our agricultural operations for our future generations. So we do have a types of agricultural financing. Number one is our formal financing institutions. For example, our banks and also our credit unions. So number one is the loans for input purchase. The formal financing institutions such as banks and credit unions, they offer loans to our farmers for purchasing the agricultural inputs like our seeds, fertilizers, pesticides, and machinery. So these loans are typically structured to coincide with the agricultural production cycle and with repayment terms tied to the timing of harvest and sales. Next is our equipment financing. Banks and other formal lenders provide a financing for the purchase of or lease of agricultural equipment and machinery, including our tractors, harvesters, irrigation systems, and processing equipment. Equipment financing allows farmers to invest in modern technologies and improve their efficiency and productivity on the farm. And then our operating loans. Operating loans are short-term financing options that designed to cover the day-to-day operational expense of farming, such as our labor, utilities, and maintenance. So these loans help our farmers manage a what we call cash flow fluctuation throughout the year and ensure that they have the necessary resources to sustain their operations until harvest time. Then for as part of our formal financing is our real estate loans. So the formal financing institutions offer long-term loans for the purchase, development, or improvement of agricultural real estate, including farmland, ranches, and agribusiness facilities. So the real estate loans provide farmers with capital that is needed to expand their operations, invest in land improvement, and transition to more sustainable agricultural practices. And crop insurance premium financing. The crop insurance helps protect farmers against losses caused by natural disaster, pests, and other risks beyond their control. Okay, so the formal financing institutions may offer loans to farmers to cover the cost of crop insurance premium, allowing them to mitigate the risk and safeguard their livelihood against adverse events. Then our value chain financing. The value chain financing involves providing financing to multiple stakeholders along the agricultural value chain, including our farmers, our processors, distributors, and retailers. The formal financing institution may partner with agribusiness and supply chain actors to offer financing solutions that facilitate the flow of credit and improve market access for smallholder farmers. Okay, so I just moved to a more convenient place. So next is for our formal financing institution is the risk management products. So in addition to loans and credit facilities, formal financing institutions may offer a range of risk management products tailored to the needs of agricultural producers. So these products include weather derivatives like our price hedging instruments and revenue insurance policies that are designed to protect our farmers against market volatility and income fluctuation. And then our technical assistance and advisory services. Many formal financing institutions provide technical assistance and advisory services to help our farmers improve their financial management practices, adopt sustainable farming techniques, and access market more effectively. So these services may include financial literacy training, business planning support, and agronomic advice tailored to the specific need of agricultural clients. Then, as part of the agricultural financing is our informal financing sources. So they are the money lenders and also our cooperatives. Money lenders often operating outside the formal banking system. They provide loans to farmers and agricultural businesses. So these loans may come with flexible terms and relatively quick access to funds, making them appealing to borrowers who may not qualify for traditional bank loans. However, money lenders may charge high interest rates, and repayment terms um, can sometimes be onerous, potentially leading to debt trap to our borrowers. While our cooperatives are members owned organizations that offer a range of financial services to their members, including savings, credit, and insurance. Cooperatives pool resources from their members to provide loans at favorable interest rates and terms. Cooperative financing can be particularly beneficial for smallholder farmers who may not have access to our formal banking services or who prefer community based financial institutions. So, the cooperatives also often provide technical assistance, marketing support, and input supply services to their members, enhancing the overall sustainability and resilience of agricultural communities. Then our rotating savings and credit association or RASCAS are informal financial arrangements where a group of individuals agree to contribute a fixed amount of money to a common pool on a regular basis. So the pooled funds are then disbursed to members on a rotating basis. So either through loans or lump sum payments. So these lenders can provide access to finance for their individuals who may not have access to formal banking services or who prefer community-based savings and lending mechanism. So the Roscas rely on trust and social capital among members and are common in many rural and our informal economies. And also our family and social network. So as part of the informal financing sources, especially we are in agricultural communities, the informal financing often occurs through the family and social networks. Relatives, the friends, and neighbors may provide financial assistance to farmers in times of need or support for the agricultural ventures through informal investment arrangements. So these networks can be particularly important during times of crisis or when formal financial institutions are inaccessible or unresponsive to the needs of farmers. Then our government sponsored programs and subsidies. So number one, we have a agri-negosyo or anyo loans. So the agri-negosyo loan programs is offered by the Agricultural Credit Policy Council in partnership with participating banks and financial institutions. So it provides credit facilities to small farmers and fisher folks, agrarian reform beneficiaries, and rural micro enterprises for agribusiness activities, including production, processing, and marketing. Then the next is the SICAT SACA program. So the SICAT SACA program is implemented by the Department of Agriculture. So this one aims to provide credit assistance to smaller farmers and fisher folk to crop production, post-harvest facilities, farm machinery, and agribusiness activities. So the program offers a subsidized interest rates, flexible repayment terms, and technical assistance for eligible beneficiaries. Okay, let's continue. In agricultural competitiveness and enhanced fund. So the Agricultural Competitiveness Enhancement Fund is a government fund administered by the DA to provide a financial support to agricultural enterprises for productivity and enhancement. So this program aims to enhance the value chain development and market promotion and infrastructure improvement. So the fund supports projects and activities that contribute to the competitiveness and sustainability of the agricultural sector. And then our expanded Sure Aid and Recovery Project, also known as Sure Aid. So the expanded Sure Aid program, this one is to provide a financial assistance and support services to farmers and fisher folks affected by natural disasters and also the calamities like typhoon or even El Nino and emergencies. It includes provisions for emergency loans, input subsidies, rehabilitation assistance, and livelihood recovery programs to help affected farmers rebuild and recover from adverse events. Then our Rice Competitiveness Enhancement Fund. So the Rice Competitiveness Enhancement Fund is a special fund established under the Rice Tariffication Law. This is to support our rice industry modernization, competitiveness, and resilience. But don't know what happened. It provides financial assistance for the development of rice farming communities, mechanization, seed distribution, credit access, and technology adoption to improve rice productivity and reduce production costs. Then our corn program. So the DA implement various programs and subsidies to support the corn industry, including production subsidies, seed distribution, post-harvest facilities, mechanization support, and marketing assistance. So the program aims to increase corn production, enhance the farmer's income, and promote the food security through improved corn farming practices. Next is our high-value corn development program. So the High Value Crop Development Program is a government initiative aimed at promoting the production, the processing, and marketing of high value crops such as our fruits, our vegetables, and our specialty crops. So the program provides a financial assistance for farm inputs, infrastructure development, technology adoption, market linkages, and value chain enhancement to increase the competitiveness of high value crop producers. So we do have challenges in our agricultural financing. And number one is the limited access to credit for smallholder farmers. So limited access to credit for smallholder farmers in our country remains a significant challenge despite various government initiatives and programs that is aimed at improving agricultural financing. So there are several factors contribute to these challenges. Number one is lack of collateral. So our smallholder farmers often lack the necessary collateral to secure loans from formal financial institutions. Many smallholder farmers um, do not own land titles or have tangible assets that can be used as collateral, making it difficult for them to access credit from banks and lending institutions. And we do have a high risk perception. Agricultural lending is perceived as high risk by formal financial institutions due to the inherent volatility and uncertainty associated with agriculture, including factors such as weather conditions, pests, diseases, and market fluctuation. So, as a result, lenders may be hesitant to extend credit to smallholder farmers, especially those operating in a remote or marginalized areas. Then, we do have a limited financial literacy. So, many smallholder farmers have limited financial literacy and awareness of available credit products and services. So, they may lack the knowledge and skills needed to navigate the formal financial system, understand loan terms and conditions, and manage credit responsibly. So this lack of financial literacy can hinder farmers' ability to access and effectively utilize the agricultural financing opportunities. And then the fragmented agricultural value chain. So the fragmentation of agricultural value chain in the Philippines truly possess a challenges for smallholder farmers in accessing the credit. So the farmers often operate at the bottom of a complex value chains characterized by multiple intermediaries, limited market information, and unequal power dynamics. That is the reality. And as a result, our farmers may face difficulty in accessing the credit to invest. And with that, in value adding activities, like for example, um, how can they be able to adapt new technology, and how can they promote their product since knowing that they have the limited access to fund their operation. Then our limited outreach of financial institution. Formal financial institutions may have limited presence and outreach in rural and remote areas where many smallholder farmers reside. So branch networks, infrastructure constraints, and operational costs may pose a challenges for banks and microfinance institutions in reaching the underserved and agricultural communities and extending the financial services to our smallholder farmers. And another one is the inadequate risk management mechanism. So the lack of effective risk management mechanism, such as our crop insurance and weather indexed insurance, further exacerbates the challenges of agricultural financing for smallholder farmers. Without the adequate risk mitigation tools, farmers may be reluctant to invest in productivity enhancing technologies and agricultural innovations due to the fear of potential losses from crop failures or adverse weather events. So, limited access to credit for smallholder farmers in the Philippines still remains a significant challenge despite various government initiatives and programs that aim at improving the agricultural financing. So, several factors contribute to those challenges. Then next, let's talk about under the challenges in agricultural financing is the high interest rates and collateral requirements. So because our agricultural production is seasonal in nature, the it co- brings a significant impact to our loan repayment. So agricultural financing faces numerous challenges, and one of the most significant is the seasonal nature, and it can greatly impact our loan payments. So number one is the seasonal income fluctuation. So agriculture often relies on the cycle of the season of production, where income is generated during the specific time of the year. So such as harvest seasons during those bounty or abundant harvest. So this means that farmers may experience the periods of high income followed by extended period of low or no income due to calamities. So loan prepayment schedules may not align well with this income fluctuation and making it challenging for farmers to meet their repayment obligation during low income periods. The weather, climate, and climate risk is the number two of the of this problem. Agriculture is highly susceptible to weather and climate risks. For example, drought, flood, and extreme temperature. So these factors can directly impact the crop yields and farm revenues. So in the event of crop failure or reduced yields due to adverse weather conditions, farmers may struggle to generate sufficient income to repay their loans. And also the input cost and price volatility. So the cost of inputs such as our seeds, our fertilizers, and pesticides can really fluctuate significantly due to market conditions, transportation costs, and the changes in exchange rates. Additionally, agricultural commodity prices are often volatile, making it difficult for our farmers to predict their future revenues accurately. So that is why the unexpected increase in input costs, the price should increasing due to a lot of variables or decline in commodity prices because of the demand of the law of supply, uh, the, the the law of supply and demand that strain our farmers' finances and affect their ability to repay loans. And then the limited access to financial services. So many small farmers, particularly in developing countries, have a limited access to formal financial services, such as banks and microfinance institutions. Even when financial services are available, farmers may face barriers such as high interest rates, collateral requirements, and complex application procedures, which can hinder their ability to secure loans. Then our lack of financial literacy and planning. So some farmers may lack the necessary financial literacy and business management skills to effectively manage their finances and plan for loan repayment. So without proper budgeting and financial planning, farmers may struggle to allocate their resources efficiently with um, prioritized loan repayments over other expenses. And then the inadequate infrastructure and market access is also a challenge. So the poor infrastructure, including our roads, our storage facilities, and market access can hinder farmers' ability to transport their produce to market and obtain fair prices for their crops. So the limited market access can result to lower revenues for farmers and making it harder for them to repay their loans. So addressing these challenges associated with the seasonal nature of agriculture and its impact on loan repayment requires comprehensive solution that involves government policies, financial institutions, agricultural extension services, and other stakeholders. So the solutions may include developing flexible loan repayment schedules that align with farmers' cash flow cycles and income generating seasons. Then, offering a financial products that is tailored to the specific needs of farmers, such as seasonal loans, crop-specific financing, and weather index insurance. And then providing technical assistance and training programs to improve farmers' financial literacy, business management skills, and risk mitigation strategies. And also investing in rural infrastructure and market development initiative to improve our farmers' access to to markets, reduce the transportation costs, and enhance the value chain for agricultural products. And also promoting the collaboration and partnership between the financial institution, the government agencies, the nonprofit organizations, and agricultural cooperatives to expand the access to financial services and support for small scale farmers. So, our next video lecture will be discussed on the part two of the Unit 5 of Agricultural Financing and Support in the Philippines.